Continuing the series about which are the best currencies in the world, today we're going to Asia, Singapore. Hello to our Singaporean friends here today. It's a wonderful city-state which is not too far from where I live in Thailand. The Singapore dollar is a currency which is being known for its strengths, and that has gone hand in hand with the economic development of Singapore. But how about the Singaporean dollar if you would take an investor perspective? So I did the research and the maths, and looking back at January 1st, 2000 as a starting date up until 31st of December 2021 to look at what is the best currency. And as before, I'm doing a comparison with the US dollar because it's a very strong currency and it's also the reserve currency in the world. US dollar or Singapore dollar? Who is the winner of the boxing match? Let's find out. My name is Greg Angelbert. I'm a life and personal finance coach. I share what I know about coaching and personal finance on a cup of coffee to help you live a life of purpose and build up your wealth. Round one, pure cash. With the current level of inflation, keeping cash in the bank might seem to be a way of losing your purchasing power pretty much every day. Having said that, if you look at the returns of the stock market since the beginning of 2022, then you might get a very different picture. Let's imagine that on the 1st of January 2000, a genie just appeared in front of us and gave us 10,000 US dollar. But the trick was that we had to put it uniquely in cash. We had to keep it in cash. And we have to keep it whether in US dollar or Singapore dollar for 22 years. Considering that, you can see the evolution of the Singapore dollar versus the US dollar from 1st of January 2000 to 31st of December 2021. That is not a pretty picture for US dollar. If you would look at it for 2022, it looks a bit better for the US dollar. 10,000 US dollar on the 1st of January 2000 was converted to 16,565 Singapore dollars. On January 1st, 2022, we converted it back into US dollar to compare with the original investment of 10,000 US dollar, and we get 12,282 US dollar. Clear here, the Singapore dollar most definitely win. Additionally, over this period, the consumer price index, the CPI, a measure of inflation, rose by 42.1% in Singapore. In the US, the CPI rose by 62.7%. Considering that the US and Singapore are two rich countries, we can roughly estimate that they would have the same basket of consumption for citizens of each country. So the 10,000 US dollar have devalued to a purchasing power of 6,146 US dollar today compared to 2000. The 16,565 Singapore dollar have devalued to 11,656 dollars, which translate into $8,643. $8,600 versus $6,100, the Singapore dollar still wins. Overall, round one goes to Singapore dollar. Round two, sovereign bonds. Now the genie changes his mind and tells us that we need to take those 10,000 US dollar and we need to invest them in 10-year sovereign bonds, whether from Singapore or from the US. He's being nice with us and believes that it's going to be a better return than pure cash. We assume here buying and selling the bonds beginning and end of the year so we can ride the evolution of the 10-year bond year by year. The bonds are the Federal Reserve bond in the US and they are the bonds from the Monetary Authority of Singapore. Our 10,000 US dollar would become 19,908 US dollar by January 1st, 2022, which is almost doubling our investment amount and is a 3.3% yearly increase over the period. If we look at our 16,565 Singapore dollars, they would have become 28,786 dollars, which is a 74% increase or 2.7% nominal return per year. Though we need to compare it to its dollar equivalent, so we use the exchange rate of January 1st, 2022, which is 1.3487 Singapore dollar to the US dollar. We then get 21,344 US dollar, which compared to the 10,000 invested originally gives us a 3.7% annual return over the period. Taking inflation into account as per the cash calculation, the 19,908 US dollar are effectively devalued to 12,236 US dollar if you had stayed with your money in the US. The 28,786 Singapore dollar would have devalued to 20,256 dollar, which is the equivalent of 15,019 US dollar. 15,000 US dollar versus 12,200 US dollar, the edge is for the Singapore dollar. The winner of this round is clearly the Singapore dollar. You like this comparison video between the US dollar and Singapore dollar? So you know what to do, and also subscribe to the channel and put the notifications on if you want to receive content like this every week. Also check out other videos from YouTubers which you can find in the description. It's interesting and important that you look at different points of view about this topic. Round 3, stock market. The genie is now going full tilt and tell us that we need to invest our 10,000 US dollar in the stock market. And to do that, we do not have to take a lot of risk. We can just invest in the top companies in the New York Stock Exchange and also in the Singapore Exchange. The two indexes that we can have from both countries are first the Dow Jones Industrial Index in the US for the top 30 companies for market capitalization. And for Singapore, we can take the Straits Times Index, which also represents the top 30 companies by market capitalization. 10,000 US dollar invested on January 1st, 2000 in the Dow Jones Industrial Index and rebalance continuously to follow it until January 1st, 2022 would have increased to 32,112 US dollar, which is more than tripling and an annual return of 5.7%. That's okay. Or 16,565 Singapore dollar invested over the same period in the STI in Singapore and rebalance continuously would have increased to 24,080 Singapore dollar, which is a 45% increase or 1.8% annual return. Not good. Let's see how it compares when we translate that to US dollar. We get 17,855 US dollar for 24,080 Singapore dollar, which gives us a net annual return of 2.8% based on 10,000 US dollar invested. That's better, but that's still not good. Taking inflation into account, the 32,112 US dollar invested in the US are effectively devalued to 22,212 US dollar if you had stayed with your money there. The 24,080 Singapore dollar would have devalued to 16,945 Singapore dollar, which is the equivalent of 12,564 US dollar. $12,500 versus $22,100, there is a massive gap, which is to the benefits of the US dollar investing in US stocks. The USD is a clear winner of this round. And the winner is, let's look at the summary here. Round 1, staying in cash, goes to the Singapore dollar. Round 2, investment with sovereign bonds of the respective countries goes to the Singapore dollar. Round 3, investment in core companies of the US or Singapore goes clearly to investment in the US. If you had planned to have some of your money invested in sovereign bonds, then you should definitely have gone for the Singapore dollar over the past 22 years. But if you wanted to take more risk and actually have a better return of investment, it's quite clear that the US dollar with US stocks would have much better performed. The future. We're moving on from our genie now to a divining spirit. The future depends on two main things. On one side, it is a return of cash, stock, bonds. And on the other side, it is the future evolution of the exchange rate between the Singapore dollar and the US dollar. The bonds for the US and Singapore are most likely to be following a similar trend over the next 10 years, to be at the same level, because they have actually converged over the past 10 years. Regarding stocks, the US stock market is much more vibrant, alive than the Singapore stock market, simply because there are a lot of companies coming in and out. There's a lot more companies in the US than there are in Singapore. 50% of the Straits Times Index in Singapore is dependent upon household names which have been there for quite a while and which are quite stable, like DBS, UOB, OCBC, Singtel, and Jardine Matheson. All of those stocks are in banking or the mature industries which are not growing very fast. The other factor to take into account is the exchange rate, and that very much depends on the policies of the Fed in the US and the Singapore Monetary Authority. The Monetary Authority of Singapore has a primary mandate of trying to keep the exchange rate not moving too much, particularly with regards to the position of exports and imports in the country, because Singapore is an export economy. For that, it's using its close to 300 billion US dollar of reserve currencies to be able to intervene in the market in case they want to see the Singapore dollar going up or down. They also rely on the strength of the economy and the perception of that strength from international investors. And the value of the Singapore dollar also depends on one side on the economy, as we said, and on the other side about the size of the assets that Singapore has. With two very large sovereign investment funds, GIC and Temasek, which represent about $1 trillion of invested assets, Singapore has a very strong financial position in terms of assets that it's managing and owning. For the US, the Fed has a mandate of making sure that inflation stays about 2% per year, and also that the Fed will support economic activity, not too high and not too low. The US has the enormous advantage of having the world reserve currency with the US dollar. That allows them to basically support economic growth with printing more money. But the party must end at some point. The British pound used to be the world reserve currency a long time ago, and we can see where it stands today. That means that there are accumulating pressures over the US dollar, and it might seem to be very strong right now, but that's not something that will last if we look at the next 5, 10, 15, 20 years. Having said all of this, so we could look at a potential strategy where you would use Singapore sovereign bond on one side and keep some Singapore dollars there, and on the other side you would have part of your portfolio with US stocks. If you're interested in more of those currency boxing matches, check out in the video description here and here. I've done one which is about the Indian rupee with the US dollar, and there is another one which is about the Swiss franc versus the US dollar. I hope this short comparison with maths has been useful to you, and I look forward to talking to you and seeing you next week for more personal finance and coaching on a cup of coffee.